previous month was concerned, and UBS believes that this particular growth trend can sustain going forward. So that is one key kicker for them. Along with that, what they're saying is that as far as market coupling overhang is concerned, they believe now it is no longer such a worry, given the fact that Grid India, which had gone ahead and asked for trial runs to be done, they haven't seen too much of a progress, and they also believe a lot of market participants will go ahead and oppose this particular move. So they believe, market coupling, if it happens, could be delayed out and be pushed out much further. Along with that, they believe market currently is not fully pricing in potential growth acceleration in trading volumes, largely driven by the green product segment.
All right. Thanks very much. So we'll keep an eye on IEX as well. So these are some of the top stocks. We're a few seconds away from the first rates, which will be on your screens. The Nifty, the Sensex, the Bank Nifty, some of the sectoral indices, and then we'll look into individual names. So what do we have? It's 24,818. So that's the first rate coming through, 24,800. Very quickly, the Sensex is starting about 0.25% lower, 80,972. So 961, 950. So, I mean, moving around. So 67, 70 points lower on the Nifty right now. So 24,775 is what we have. That's 1/3% now. Bank Nifty is down 150 points, 50,427 on the Nifty Bank. That's 150-point knock, about 1/3% lower there as well. So this is, I think, largely on expected lines. The IT index is down about 0.4%. The Nasdaq was down 2.5% on Friday. The heat map, the Nifty heat map gives you a snapshot view. I mean, I think that about 14, 15 stocks are higher. The rest of the sort of Nifty 15 names are all starting at least in the red at this point in time. But all about stocks as always. Reema, take it away.
So let's start with Shriram Finance. That's the top Nifty gainer. UBS has raised the target price to 38.50. Abhishek was just telling us about it. Britannia also opens up in the green. Remember, they've got all the approvals for capacity expansion. They're planning to invest about 300 crores. This is at the Ranjangaon plant. HUL is also one of the big movers. It's a near 1% gain on HUL. They formed a committee to evaluate the future plans for the ice cream business. So some FMCG stocks are higher. You've got strength in Asian Paints. It was up 4.5% last week on the back of a decline in crude prices. They've started off this week on the positive note. Life insurance companies, SBI Life, HDFC Life too, have opened up with strength. In the IT names, it's TCS, which catches your attention. And Bajaj Finance, remember, it'll get nearly 3,000 crore from the monetization of its stake in Bajaj Housing Finance. So there is a green tick on Bajaj Finance on Monday morning. On the way down, power stocks are seeing some profit booking. So NTPC Power Grid under pressure. Metals are on the back foot. Maybe the decline in global, just a global outlook, the sell-off, the risk-off that we're seeing in global markets is putting pressure on Tata Steel, Hindalco this morning. ONGC too is coming under a bit of pressure. So ONGC is down nearly 1.5%. For banks, it's Axis Bank is a bit subdued in trade. We'll pull up some of the other private sector financials to see how they've opened up. HDFC Bank is flat. ICICI Bank a little bit of a downtick.
All right, let's look at the mid-cap end of things as well. There are nearly twice as many stocks declining as against the number of stocks which are advancing on the National Stock Exchange right now. The mid-cap index actually is faring much worse than the frontliners. At least at the open, the mid-cap index down almost 0.6%. So that's something we most definitely keep an eye out on. What's actually leading the losses from the F&O space, we have Granules, which is down about 3.5%. Remember, Ekta did tell us about the US FDA issuing 6 observations for their Gagillapur facility in Hyderabad. The other one which is losing is also Lupin. Again, here too, the company may not be able to realize the full potential of its kidney drug Gynarc. And this contributed, as per analysts, almost 30% to their FY26 EPS. So there's a bit of a downside risk out there. Nippon Life India is down as well. Though a couple of these life insurers are doing well this morning. So HDFC Life is up about 0.7%. SBI Life is up around 0.8% as well. So Nippon is the only one which is an outlier with a cut of almost 1%. The FMCG stocks, they're by and large doing extremely well. Marico is up around 8%. Colgate is up around 1%. Dabur itself up around 1.5% as well, as is United Spirits up about 1%. One stock which really stands out on the way up is SP Apparel. Remember, we had the management join us earlier today speaking about a possibility of a 20% growth and nearly 20% of their production coming in from Sri Lanka in the near future, along with some uptick coming in from Bangladesh as well. So all these factors doing well. Seems like Metro Brands too, the large trade, has been absorbed. The stock up around 3%. So a lot of stocks in focus, though more declining than the number of stocks which are advanced.
Oh, no, clearly. So it's about 3:1 in favor of declines. So that's the first look at the breadth of the market. It's skewed in favor of what is down right now. Now, Prestige Estates has got tremendous volumes. It's coming up as the second largest volume-led loser. It's down about 3%. Stock actually had a bit of a sharp up move recently. You had granules, I think we mentioned, with a 3.5% cut. I was talking about Ola Electric earlier with Prakash. Ola is down about 3%. That lock-in opens up today. I mean, essentially, not all those shares are going to be sold, but you got, I think about 4% of the equity that is free for trade now with the lock-in ending. Godfrey Phillips, we mentioned, 4% lower. There is Tile Bazaar, which is the recent listing, which is down about 3% right now. Moripun Labs is down about 3%. SJVN is down about 3%. Hindustan Copper is coming up with a 3% cut. Wockhardt Pharma was, of course, it sold off on Friday as well. There was, of course, there was a press conference by the opposition, and the stock actually has come off from the recent highs of about 1,100 to about 989 in 2 sessions. So that's a 4.5-5% cut. VST Industries is down about 6%. I think we were mentioning a block deal which has happened on VST earlier. We'll put that up. But that's a large, sharp cut coming through. 450, 451. The block deal happened, of course, on Friday. And a large marquee sort of investor in VST has been the seller. Bector Foods is down about 5%, 1719 on Bector Foods. Raymond is down about 3% or so as well. Raymond has also moved up very, very sharply. The advanced decline is not budging. It's right there, and very little is moving it at this stage. On the upside, Premier, the new listing is up 7%, 7.5%, 8% actually. So 1179 on Premier Energies. Look at that go. Just incredible. We have Deep Industries, which is coming up with a 13% pop, 450 on it. Very large volumes, and that's why we're sort of talking about this one.
And there's an order win for Deep Industries. It's about 1,400 crore plus.
So it's a large one. So it's reacting. JM Financial is up about 2.5%, 127. Mankind is showing some action. Mankind is up about 3.5%. Stocks largely, it's come off the lows, but it's not done very much. They made that large acquisition. Keytex is up about 2%. Small name. And Minda Corp, but volumes start to dry up if you go down the list. So this is broadly what's going on.
I'll be very interested to see what happens to the sugar stocks because, it's around September, the sugar season, so sugar year starts between September, October, and Balrampur Chini has taken off. And typically, sugar stocks move in tandem. So Dhampur Sugar down about 2% right now, Balrampur Chini up around 1.7%. But if you pull up the intraday chart of the stocks, you would know that, there is some traction building up out here. All these stocks typically move in tandem. So if one leads the charge out here, do others follow or not is something that we'll keep an eye out on. So there you have it. Opened in the red, saw a bit of a spike, saw another spike, and now at the high point of trade, whereas the others are still struggling at lower levels.
All right. So we'll keep an eye out on this space. Usually moves as a pack when it does. And we'll see if that is the case today. Harish Krishnan is with us, co-CIO, Head of Equity at Aditya Birla Sun Life Asset Management Company. Harish, good morning. Good to have you here. Thank you for your time. I want to just understand what you guys are doing at Birla in terms of allocations, activity. And I want to preface that with something that you tweeted recently. You you quoted data from a report from ICICI Securities, and you said that the number of companies in the top 500 where earnings yield is greater than bond yield is now about 47. The lowest reading was 32 in December of 2017. This is, top 500 universe where earnings yield is greater than bond yield. So just sort of prefacing my question with that data which you yourself put out. Go on, Harish.
Morning, Prashant. So What we have seen over the course of the last 18 months or so has been that risk has got disproportionately rewarded, especially as we go down the curve, be it in terms of mid, small, and more so in micro caps and SME. Lesser said, the better. Now, in this context, what we are kind of doing in our portfolios is basically moving up the curve. We are trying to consolidate our holdings. We have increased our allocation to large and larger mid caps. Trying to book our profits into many sectors which have done exceedingly well. We've also seen over the course of the last 6, 7 months or year till date, actually quality as a style doing significantly better. And this was our call at the start of the year that value had done exceedingly well over the course of the last 2, 3 years. We did think that growth and quality would start making a comeback, and we've seen quality starting to make a comeback out there. Sectors like, say, pharma, where we have a large position, IT, again, a sector where we have an overweight to a certain extent on the consumer or the consumption side. These have all been names that have kind of helped us, kind of position for this kind of a change, I would say, in terms of sectoral churn, which is happening. So, by and large, the sense that we get is that one needs to be mindful of taking on more risk at this point of time. Doesn't mean that we're going to see a massive crash, etc. But we do think that there can be a reasonable amount of churn in terms of performance going ahead, and that is what we are kind of moving and navigating within our portfolios.
So what's the kind of...
Sorry, Harish, hi, morning. So what's the top-down call now? First on the US economy and on the markets there, because investors are still grappling with the uncertainty of US health. Then there is uncertainty related to the elections. US markets are virtually at all-time highs, barring the little bit of a correction that we had last week. And historically, this has been a challenging year. So what's the call first in the global markets, US in particular, and then the flow through to India?
So from a US perspective, we do think that the corporate health of US is in very good shape. The consumer health of US is also in very good shape. So clearly, while there is an interest rate which has climbed up significantly and there is an anticipation of a slowdown and rates are likely to be headed lower, we think that this is possibly the most well-anticipated recession or slowdown in the making. Market observers and people and CXOs have been waiting and watching for this over the course of almost the last 18 months. So therefore, when it does happen, we don't think there's going to be a panic. Yes, in the near term, there could be some amount of consolidation, some amount of steam which is going off. But we don't think that this is a precursor of a massive fall or a massive correction in the US, and that kind of flows through across most other risk assets as well. Wherein we think that especially emerging markets, which have not really performed, barring India, could be a good place to be in, as and when the rate do get through over the course of the next 12-18 months. Coming through from an India point of view, I think while we are going to see continued strength in the economy, I think at the margin, and markets do work at the margin rather than in absolute terms, we do think that there is some amount of softness. So if you look at top line growth of corporate India, there has been reasonable amount of sluggishness, and while there has been a significant margin expansion that helped through earnings over the course of the last 18 months, I think top line growth needs to be a lot more focused upon going ahead, given the fact that there is only so much margins that can go up. So in that context, we do think that it makes sense to be in fewer pockets where there can be a potential improvement in top line growth. There can also be fewer sectors where there can be a potential of significant margin expansion. So if I were to think about sectors sectors where there is, and which haven't performed well over the course of the last 3-4 years. Sectors like, say, for example, cement, which has been a space which hasn't had a great 3-year run. We are seeing consolidation. Also, we do think that cement is a proxy play on energy prices because at every aspect of the value chain, it's essentially transporting energy, and lower energy prices therefore can help with improving margins. So I think that could be a space that we have a contrarian kind of a stance. Similarly, consumer durables is a space which hasn't done much over the course of the last 5 years. Of course, this calendar year it has kind of got its act right, but we think that there is still a lot more room to play out as far as consumer durables is concerned. So I think there are pockets where we do incrementally allocate, but a broad brush kind of a move is not something that we anticipate, especially in the near term, even as we continue to remain positive on the broader stance in equities from a medium to long term point of view.
All right, we'll ask you to hold on to your thoughts, Harish. We also have Vetri Subramaniam, man of many cycles, Chief Investment Officer, UTI Asset Management, joining us now. And as we speak, on cue, the market's extended its cuts. The Nifty is down by about 100 points, close to around 24,750. SBI is one of the stocks which is lower right now. The Midcap index, when it started, was down 0.6%, now down about 1% as well, with a cut of almost 600 points. What are the stocks which are leading the declines? It's the same ones which opened lower are now extending their cuts. So granules, for instance, now down about 4% as well. Good time to welcome you, Vetri. Where do you stand at where the market is right now? What are your thoughts, and what are the investment ideas?
Sure. Thanks, Manu. Well, not much has changed. It's still a reasonably richly valued market, and therefore one really has to, dig quite deep to be able to identify where there is value. I think what our messaging to investors has been that this is actually a time where one should be more concerned about risk. This is a time where one should be more concerned about asset allocation. Stick to the asset allocation in line with your, goals. This is not a time to dial up risk. If your neighbor is making more money than you are, so be it. You should be aligned with, where you think your asset allocation is tolerable relative to your medium-term outcomes. When you think about valuations in the current marketplace, I'd particularly point to the small and mid-cap space where, valuations are not only very rich in absolute terms. This is one of the few times in my career where small cap valuations have actually moved to a premium to large cap valuations, and that I think is very unusual, and also a sign of perhaps a need to be slightly more risk averse in that territory in particular.
Vetri, hi, morning. Sort of retail inflows are still gushing through this month as well as fast?
But we don't get daily data, but I don't think there's too much of a change, simply because keep in mind that essentially the pipeline that's coming through SIP is intact. But keep in mind, Prashant, and I think I've seen you all talk about this as well, there's a gush of supply coming through at the other side as well. So as a capital market participant, I'm happy that capital formation is well and truly underway, but I don't think this is a one-dimensional perspective that we should be keeping. There is a massive supply of flow which is coming through from promoters, from new issuances, as well as from strategic holders, including Ps and VCs. So every day you're flooded with a new set of either block offers happening in the marketplace, or QIPs, or OFS, or IPOs. So it's a very hectic market, and that's the reality of it.
I was talking to a banker over the weekend, and he said, well, everybody wants to do an IPO, and that is maybe not such an exaggeration as well. He was joking, well, it not be very far away when people securitize their own personal earnings and IPO themselves. It's I mean, just joking. But Vetri, the paper which is coming, again, very difficult to generalize. Is there a bit of euphoric element in how these issues are priced as well, or they are reasonably priced? A lot of what is coming, and you must be seeing most deals.
We do, but we've been selective. We've been selective for a long time now, and I think it pays to be selective in these kind of environments. So we typically don't participate unless we are clear that this is something we are willing to hold for the medium to long term. I think many people have seen the data about how much flipping is going on in the IPO market. That's certainly not something that we do from the fund perspective. So we only participate if we are clear that we are willing to add to our positions at some point and stay invested for the long term. But I don't want to generalize, because I think you've just got to treat each IPO on its merits rather than generalize it.
Harish, have you all been participating in any of the IPOs?
Of course, we've been participating, but I guess we've been selective as well. So roughly about 1 in 5 IPOs over the course of the last 3 months is where we've generally kind of, put in our monies. I think, as Vetri said, it's great to capital formation through the equity markets. We do think that many of these IPOs need to be evaluated so that, we are ready as and when we get greater comfort on valuations. And more importantly, like I said, it's more an assessment of the risk that we see at this point of time, wherein we want to consolidate into our holdings rather than adding to the tail. So that really is the focus at this point of time. Because rather than having a fringe holding wherein we may get, say, 10, 15, 20 crores, we would rather want to consolidate at the top where we can take meaningful bites of, say, 1,000, 2,000, 3,000 crores. And there are many listed companies which have not kind of been in the limelight over the course of the last 3-5 years, which do provide greater margin of safety for us, wherein we are moving our overall portfolios towards.
All right. Vetri, you did, and both of you all actually, to be very honest, did stress a lot on asset allocation at current point in time. As we speak, in fact, the Nifty bank's taken cues and has recovered from the lows, moved mildly into the green. But on asset allocation itself, you said you'd be happy to underperform in the very near term so long as you have all your portfolio investments, etc., secured over the medium to long term. For a moderate risk capacity individual, what should the asset allocation be according to you, Vetri? And in the allocation towards equity, in that, what according to you would be your sectoral breakdown?
Sure. Honestly, that's a very difficult one to answer, because I think every person's risk appetite and financial goals are different. But what I can talk to is essentially the kind of asset allocation which we manage in the schemes where we take responsibility for asset allocation. So if you look at our multi-asset allocation fund, our net equity exposure can come down to a minimum of 20. It can go up to a maximum of 80%. Currently, we are less than at the halfway mark at about 45%. So in a way, it is an underweight equity stance in the context of asset allocation that we make in that scheme. And that's a function of valuation. So I wouldn't presume that this is the right number for everybody. But really the point that I would make, and I keep getting asked this question, when will the market correct? Will it correct over time? Will it correct in a sharp cut? And the answer to that is that we really don't know. But there is a way for every prudent investor to prepare himself or herself for those kind of outcomes by sticking to your asset allocation rather than trying to predict when the market will correct and how it will correct, neither of which I have seen anybody do consistently and accurately over 30 years now in the marketplace. So, use the tools available to you rather than focus on something which is impossible to do. In terms of sectors which are attractive, honestly, there's only one sector top down that we find reasonably attractive at this point of time. It's a combination of above average fundamentals with below average valuations, and that, roughly speaking, is the banking and financial services sector. So though that's the one sector where I have absolute comfort.
Again, only half joking. I've been Mangalam's in asset allocation usually, but asset allocation, gold and equity and I was debt, etc. Right? Right now, asset allocation means
in equities,
large cap, SME, micro, mid caps.
And not to lose sight of a lot of people who are sitting on the sidelines, via the unlisted space as well.
I'll tell you, I was at an event a month, maybe it's been a month now. There was a fixed income CIO, there was an equity CIO. The fixed income CEO was more bullish on equities than I won't name names here, but that's the kind of market we're in. Vetri, the old saying, right? This time it's different. you sometimes do feel that, and that's the beauty of markets. They, the rise can make you believe, the fall can make you believe anything. And you start to have to, you really have to pinch yourself to say, well, this has happened before. But what's your sense? I mean, I'm not saying, well, the question is not whether this time is different, but do you think there are things maybe a little different, maybe a little more supportive of the underlying sort of exuberance that we are seeing? And I'm sure you would agree with some, right? And disagree with others. Just briefly, if you can share your thoughts.
Yeah, sure, Prashant. Look, it always is the case that when valuations are rich, you've got news flow, which is extremely supportive. And when valuations are, at the cheaper end, the news flow is rarely supportive, right? So this is the reality that we deal with in the marketplace. Could things be different this time around? Maybe they could be. But, I've learned the hard way that rich valuations tend to sort of eat into forward returns, whereas cheap valuations tend to add to forward returns. So I'm not suggesting anybody go 100% into fixed income or whatever other asset class they deem to be attractive relative to rich equities. All I'm saying is stay the course. This is not the point of time where you want to look at what others are doing. Now, I hear things like this is India's decade, this is India's century. As an Indian, I'd be delighted to see that happen. But as an investor, the lesson that I've learned over time is that prudence and risk management is the only way to stay in this game for the long term. Being invested for the long term is as important as what happens. And what people forget is that if you overextend yourself, if you leverage, if you overextend yourself, you compromise your ability to stay invested for a very long time. And the most important part of the compounding equation is not how fast you go, it is the period of time that you are able to remain invested.
Great conversation. Thank you, Harish and Vetri, for your insights in the markets and the way ahead. We need to slip into a very short break. On the other side, we'll be joined by Atul Jain, Managing Director of Bajaj Housing Finance, as their IPO gets set for subscription today.
Welcome back. Well, the markets bounced nicely. We're down about 20 points, which is off the lows by quite a bit. More on markets in a bit, but the primary market action is as hot as ever. Bajaj Housing Finance's much awaited 6,560 crore IPO opens for subscription today. The issue includes an offer for sale of 3,000 crore rupees and a fresh issue of 3,560 crore rupees. Bajaj Housing Finance has also raised 1,758 crore rupees via anchor book ahead of the IPO. Well, let's talk about what Bajaj Housing wants to do in terms of growth rates, because that will be relevant for you as a potential investor. Atul Jain is Managing Director at the company. He's with us to take some questions. Atul, good morning. Great to have you with us here. Thank you for your time. Prashant this side. Housing finance is the sweet sector, long runway for growth, unending demand as far as the eye can see. I mean, Bajaj Housing comes from a stable which is really very highly rated, so cost of funds is not a problem. So give us a few numbers, Atul. What should we expect in terms of AUM growth at Bajaj Housing for the next many years, what should net interest? What's the ideal net interest margin for Bajaj Housing going to be from here on? Go on.
Prashant, I think you have got me off the wrong start. You are fully aware during the IPO process, we cannot talk about projections. So I'll have to take excuse on this question because what we can refer is what we have delivered till today. Prashant, what we have been growing at the rate of, in last 3 years, at the rate of a 31% AUM. Past growth is not a reflection for the future growth. But the housing market, as you called out, is very big. The market is very big, and compared to while our absolute size, which is a 91,000 crore assets as of 31st March and a 97,000 crore assets as of a 30th of June, look in absolute sense reasonably big. But compared to the market size, I think we are still very small. So all segments of the market, whether it is, because we are in mortgage in all segments of the market, whether it's a home loan, loan against property, lease rental discounting, or a construction finance, I think all sectors, all segments of the market have a clear runway and a very large runway, given country is growing, given housing demand is growing, given mortgage segment itself has been growing at the rate of a 12 to 15% across industry. So we believe, given our relative size, we have a reasonable path and a highway to grow. We can't talk about specifics, Prashant.
So on a 1 lakh crore book, can you continue with the historical growth rate? Now, I'm not putting any numbers out, but you said we could talk about what you've done.
So we will, our attempt will always be to grow faster than the industry. That's what, Prashant, we can say. Yes, of course, as a size grows, what you are referring is the difficulty to grow at the similar percentages. However, we feel, again, to in a way repeating what I said, that given our relative size compared to the market being lower, we feel that we have a clear highway in front of us.
I remember our conversation, Atul. Hi, this is Rima here. You told me that the housing loan market itself is 30 lakh crore plus. The loan against property market is 10 lakh crore plus. And projections by CRISIL suggest that this market is growing at about 13 to 15%, at least for the next 3 to 4 years. So for you, per se, the developer finance book has been growing faster. Is that something that will continue for the next 2 to 3 years? I'm sure you have that visibility. So in terms of the products that you offer, for the next 2 to 3 years, which ones are growing faster? Where will we see perhaps a little bit of slowdown?
So Rima, what we are, since we are registered as a housing finance company, there is a regulatory construct on our asset composition, which is first regulatory construct is 60% of our total assets have to be residential and 50% have to be home loan. So construction finance is a part of the non-home loan segment, because as a regulatory construct, only 50% of the assets can be which are non-home loan. So construction finance, lease rental discounting, and loan against property, we take a view depending upon, at a point of a time in the market, what is the return versus risk in that construct. If the market had been growing faster for construction finance in the last 2 years, we have grown faster. If the market grows in future in other segment faster, and we believe the opportunity to grow there and the risk return ratios are better, there will grow. For construction finance, we also have a requirement to keep on working in the way we work, because it acts as a funnel for home loan, which is our retail business, because it helps us build the relationships in the market, because developers are the primary sales points, and if we have a relationship with them, it helps us to be present and their counter for home loan. So again, a clear pathway, I think, depending on the market situation, and as market grows in construction finance, their housing boom, what has been there currently, boom remains, and the demand remains. Happy to keep on growing.
Not happy to keep on growing. You've spoken about, a reasonable path / highway to grow. So we'll while not pin you down to numbers because you can't obviously project them, the last 3 years, your loans have compounded at a little over 30%. Just wanted to know, when you say it's a highway, is it, compounding at 25 to 30% or probably higher now that you get a little more money into your kitty as well? Just a rough range over a medium-term period that you're aspiring to grow at.
Again, regret we cannot be specifics in terms of a range. Like I said, that highway to growth is there. And just to add the point, money raising is not going to change the highway to growth, because we are well capitalized. So the capital had been available as a private company as well as a 100% subsidiary of Bajaj Finance. We had been raising capital as and when required. This is an effort to diversify the source of capital. We had been raising money on the lending side separately from the parent company. But now this is an opportunity because having reached a particular size, we felt there is a time for us to even diversify the sources of capital. That is why this is a diversification of a capital source, not in a way creating an extra width for growth. The growth which would have happened as a private company would continue to happen as a public company as well.
So with this being diversified, do you getting capital from other sources as well? What does that then do to your margins? Because, I mean, if, the growth side is intact, no problem. It is the liability side, which, you are diversifying right now. What happens to your margins? Do you have any targets on improvement out here?
No impact on margins from the capital raise because, of course, for some time when there is a capital excess, their margins expand because of, your leverage ratios goes down. But on the borrowing side, since we already enjoy the highest credit rating in the country from the credit rating institutions, and lenders have been having the confidence on the parentage and our track record, we had been borrowing at a quite competitive pricing. So we don't expect a compression in the cost of borrowing by public issue or by going public, or expansion in the margin or a contraction in the margin. Margins are not getting impacted by our raising money through public. The only impact, which is the impact of an excess of capital for a period of time, that expands margin to a certain extent.
Okay, all right, we'll leave it there. Atul, appreciate you joining us. Good luck with the issue. And thank you very much for being with us here. And we'll hope we can talk specific numbers in terms of guidance, etc. Post-listing, on the day of the listing, which I'm sure is going to be a great one. So that is Bajaj Housing Finance with some perspective. Well, the GST Council will be meeting later today, and this is going to be important. And they're going to talk about a number of crucial issues, from taxing gateway fees for small car transactions to deliberating on tax treatment for insurance premiums. The council has its plate full. Let's get a curtain raiser with Timsy, who is joining in, who's been reporting on some of what could be on the GST Council's agenda. Timsy, over to you.
Well, a slew of items on the agenda for the GST Council when it meets on 9th of September. Let's take you through some of the key ones. The Council is likely to have a heated discussion on cutting GST on health and life insurance. Council will discuss Fitment Committee's proposal to allow GST exemption for only pure term individual life policies and reinsurers, which comes with a revenue implication of 213 crore rupees. For health insurance, sources say that the Fitment Committee could not build a consensus, and thus it has suggested a 4-option mechanism, including a complete exemption for senior citizens and for policies up to 5 lakh rupees, or exemption to only those premiums which are paid by senior citizens, or reducing GST on all health insurance premiums to 5% with ITC. The Fitment Committee has flagged the potential revenue implications for all of these options, saying that any cut or reduction in the GST on both life or health insurance should come only when it is being passed on to the policy holders. The Council could also clarify on whether 18% GST should be levied for card transactions below 2,000 rupees on payment aggregators such as Pine Labs, Razorpay, etc. The Council nominated Fitment Committees of a view that these aggregators are intermediaries and not banks or financial institutions, thus they are not liable for GST exemption. Currently, payment aggregators are exempt from GST for transactions below 2,000 rupees. The Council will also be taking a status update on the Group of Ministers panel on rate rationalization and real estate, where both the panels are likely to seek more time before presenting a final report. The Council will also discuss upon the current status of the compensation cess. Here, the Council will be presented with a view that the cess collections are still short of about 1.37 lakh crore rupees, and thus will have to be continued through FY26. Apart from this, a lot of clarifications are expected, including a breather for the foreign airlines, data hosting sector, namkeen and FMCG sector, and auto and two-wheeler industry on the taxation of seats, relief for power discoms and consumers on electricity connection ancillary services, setback for highway builders, and much more. So let's see what all does the Council decide when it meets on 9th of September.
All right, Timsy, thank you very much. That's a pretty comprehensive readout of what could be on the agenda. Mr. M.S. Mani is partner GST, Deloitte India. Mr. Mani, good to have you with us here. So you heard Timsy, but if you could tell us, for viewers who are watching, and they're looking at which sectors could come in for changes, what is top of your mind? 3 or 4 sectors.
So the top of mind sector is obviously insurance, where we have seen some action in the last GST Council meeting as well, and some action is expected in this GST Council meeting as well. Now, health insurance and term cover up to a certain amount are essential ingredients of insurance. And the logic over here, to my mind, is very simple. On the one side, we are aware that India is an underpenetrated insurance market. We are also aware of the fact that there is no health insurance that applies to the masses through a social security network. And therefore, most people have to go and get their own health insurance, whether it's through on their own or whether it's through their employers. In that situation, having a minimum threshold which is exempt from GST for health insurance, similarly for life cover, would be very, very welcome and would do very well with the whole philosophy of GST, that the intention is not to burden the masses or burden the common man. The challenge, I believe, is going to be in what kind of segregation is made, because there would be a segment of people who take very high amounts of health cover and very high amounts of term cover as well.
Got it.
How do we segregate that, and how do we keep that outside the exemption limit, I believe, is going to be the discussion.
Got it. No, that is insurance. And I'm assuming most of this will be passed through. This will, I mean, at the end of the day, they'll have to lower the premiums, etc. So that's insurance is one, health and term cover. What are the other sectors, sir?
I think airlines is one sector where we are expecting something, because in the past, airlines have been having a tough time together with shipping lines. Both need to be taken together at some point of time. We also have some issues with respect to the information technology companies, where some of them have received demands in respect of, transactions which are merely in the nature of remittances without any underlying services. So that's again one sector which could see some clarity possibly in today's meeting. One very key area which is a bit sector agnostic is the fact that everyone would like to hear what is the latest on the rate rationalization, because at some stage we would like to see fewer rates in GST. I also heard your colleague mentioning that compensation cess is expected to be extended till 26. That is something where, again, industry would want some clarity, because this was originally intended only till 2022 and we are in 24. So at some point of time, the compensation cess has got to, go.
Is it possible, Timsy also mentioned real estate. Do you think something could be done on cement? We've seen some news reports, etc. I mean, at least demands.
So we have been, cement is taxed today at 28%, unlike many of the other building items like steel, which are taxed at 18%. So yes, there could possibly a reason to look at that. But there is also an issue with the real estate sector faces in respect of transfer of development rights, in some cases, land transactions which are being subjected to GST today. So possibly we'll see some clarity in respect of many of the other real estate transactions, such as lease of freehold land, such as transfer of development rights, all of them.
Okay. All right, Mr. Mani, we'll leave it there. Thank you very much for joining us. Sorry, a quick preview. This is just a preview, and we'll get into some of the details later through the course of the day, and I hope you will join us then when the meeting, etc., does get underway. That's going to be later. The market has bounced nicely. We're down just 10 points now, 24,842. But Mangalam, we have Senco Gold with us.
We do have Senco Gold, and as on cue, a lot of the jewelry stocks are actually doing quite well. Senco Gold itself is up around 2.5%, but look at something like a TBC up around 8%, has been a big mover all of this month. Some of the earlier known jewelry companies have seen a big move as well, debt-ridden ones, which are seeing some bit of an impact, after their settlement. So PC Jeweler, for instance, up around 4% as well. That's another stock which is up around 31% this year, and a big mover too. Senco Gold, the news that's backing this company is that they've incorporated a new subsidiary called Sense Fashion for exploring new businesses in categories like lifestyle products, lab-grown diamond jewelry, among others as well. A lot of the jewelry companies are actually looking to cross-sell some of these luxury products once they establish connect with the customers at the luxury end itself. We have with us the MD CEO Suvankar Sen joining in. Thanks a lot, Suvankar, for joining in. So one believes that the rationale for that is to improve upon the relation that you've already built from a high-profile customer and try and cross-sell them some of the other luxury products as well. What I want to know is, one, the expected investment in this business over the next few years, target revenue from the non-jewelry businesses over the next few years as well.
So see, the investment that we would like to put in, against these new businesses that we are putting will be around 50 to 60 crores in the initial phase, and then every year maybe we will keep adding about 25, 30, 35 crores for the next coming 4-5 years. And as we would keep on increasing the traction, in terms of opening more number of stores or diversifying of the products, investing on the brand. So there has to be a sustainable, profitable proposition towards this. But what is most important is the opportunity that lies along with us. As you rightly said, that you're already having a group of customers who are loyal to you, who have been buying products which are mostly jewelry from you. Now, if you look at it, Sensex, the brand name we're calling it Sensex Fashions Limited. Now, our lab-grown diamond comes under that particular brand. The leather accessories that we shall be launching would be coming under that particular brand. And there will be more such products that will keep launching over a period of time. If you look at the international luxury market, if you see those brands, they are serving customers with a variety of products. If you look at the young generation of India today, they are aspirational. It is the upper middle class who would like to evolve themselves and with the growth of the country and economy. And as a brand which has been focusing on design, focusing on lifestyle, on luxury, because jewelry, though in India it is culturally very much integrated, but with the everyday wear and with all the various collections and designs and occasions that are coming up with, women today would like to upgrade themselves with the latest trends in fashion. And with that thought process, with the new age opportunities that are coming up, I think that is with which we have been incorporating this company. The operations of such products had already come under the Senco Gold Limited. This is just like a wholly owned subsidiary that had come under Senco Gold. Yes.
You decoded the opportunity size, you've decoded the rationale. 50-60 crores is what you're looking to invest in, thereafter 25-30 crores every year. What I wanted to know is that these leather, non-leather accessories, perfumes, lab-grown diamond jewelry, are you going to sell them under your brand, or are you going to sell third-party brands? Because there is an already established preference for known brands. To build a brand again in the luxury end may require some doing. What's your right to win here, despite having a lot of customers?
So, we would want to build our own brand. If you look at the existing brands that are there, well, most of them would not be from our own country. Many of the brands are international brands, which we as consumers would be, aspiring for the brand that they have built over the years. But then while we are globalizing ourselves and India is opening up to the global market, I think that Indian jewelry brands or Indian brands per se, nothing to do with jewelry per se, would want to strengthen themselves, upgrade themselves, focus on quality, and ensure that we ourselves create enough traction for our Indian consumers as an option for them to consider. I think that's the thought process with which we want to move forward.
So as a part of your business plan, Mr. Sen, how much do you think the non-jewelry business will contribute, say in the next 3 years?
See, the non-jewelry business over the next 3 years, if you look at lab-grown diamond jewelry, that has a big opportunity. Now, that can be up to 3%, 4% of the overall business, because in terms of the ticket sizes, they will be much lower than the jewelry ticket sizes that are there. Even for that matter, the other products would be of a much lower ticket size. So I think in the coming 4 to 5 years, I think non-jewelry business would be about 4 to 5% of the overall business to begin with.
Will be about 4 to 5%, right, of your overall revenue. And what about margins?
See, the margins for these kind of products are usually on the higher side. So if you look at it, like in diamond jewelry, we have a margin of about, say, 25 to 30%. Similarly, for such products, the margins will be in the range of 25 to 30, 35% as well. So, as we keep moving on and keep discussing that, yes, when it comes to gold jewelry, there is a competitive intensity, there is a downward pressure on the margins. I think that, bringing out the whole concept of lifestyle, fashion, design, and also the kind of products that we are selling in, it will give us an opportunity to protect our margins while we keep increasing our business and volumes and acquire more customers. These products will help us to buffer up on the margin side.
Steady state basis, what kind of margins would you do in a business like this? Because, the first few years you will be building brand, you will be investing, and obviously, it will cause a bit of a dent to your overall book. So on a steady state basis, what are the kind of margins that you're expecting here?
So the margins for this product, if you look at the gross margin level, would be around 30-35%. the investment that we will be needing to do is in terms of brand building, in terms of the inventory and the products that we would be putting in. It will be in terms of the infrastructure of the stores that we shall be opening up on. So those will be more on the fixed asset side, when it comes to the store part of it. Other than that, it's all working capital. It is all about the inventory. And with your customer base, so we have about more than 10 lakh active customer base and building up and adding 3 lakh, 4 lakh customers every year. And with the young generation focus in mind, I think these will only help in to cater to their needs and their preferences.
All right. Just finally, before we let you go quickly, how things on the jewelry side? You said second quarter is when, the fireworks will start to begin ahead of the festive season. And in the geography where you are, in East India, festive season comes a little earlier than every other part of the country. How's sentiment shaped up so far? 8 to 9% sort of growth is what you've targeted this year. Is there any chance of an uptick here?
So let me tell you that post the cut of the duty rates, which happened in the end of July, I think that the whole jewelry industry has been seeing a very large traction, consumer interest. A lot of their wedding jewelry buying of consumers are being done already in this season, because I think consumers have tried to avail the opportunity of the lower of the gold prices. And the footfalls have been very well. I think that in a way, if I may say so, that it is quite unexpected, because our whole focus was a festive season of October, but then the September itself have been very, very, I would say, we are very happy with the way that we are seeing the customer traction happening, and we are very positive that the coming month of festive season will also be very good. So the target growth that we have been talking about, so Q1, we've been growing at what, 7.5%? That's what we saw in the after the end of the Q1 results. But if you look at the Q2, we are in the middle of September, but till August, the growth rate compared to last year has been about upwards of 15%. So you can imagine that the July and August have had substantial growth in order to make sure that YTD growth till August has been above 15%.
Oh, wow. Mr. Sen, good to hear that, and thank you very much for joining us. Market certainly listening. Stocks moved to the high point of the day. It's up about 4% or so. Good luck with the new lines of businesses as well. We'll speak again soon. Thank you very much. Well, I think the market deserves attention because that has also picked up just about 15 points lower. Mitesh is with us with what he'd want you to do now. Mitesh, morning again.
Good morning, Prashant. So I think it's a market, which while did open weak and was weak, I think it's tried to recover. I'm still hoping that the index could, possibly start getting past 24,850, and that could pave a way for a pullback to about levels of 25,050, 25,100 odd zone. So it's still not a strong market, but because of the fact that we've just seen first bout of selling and profit booking, there is some hope of a pullback which could be happening. So we're trading with a mixed bias right now. On the stock side, I have a sell on Power Finance Corporation with a stop at about 536 and a target of around 500 on the downside. I think that's the area which the stock could possibly test. While also a buy on AU Bank with a stop just below day's low of 696. So 694 half is what I would recommend, and a target of 730 on the upside.
Got that, Mitesh. Thank you very much for that. If you can pull up the intraday for Senco, I think it's up even more. I mean, I think we started the interview with about a 2.5%, 3% pop. It's up 5% now. So 4.5%, that's a sharp spike coming through. The last bit about how the Q2 is spanning out, especially September, I mean, looks like they've been very pleasantly surprised with the underlying sort of strength and demand which they've
It's actually caused a flutter among all the other jewelry companies as well, which have been doing well already. But look at something like a Titan. Titan's moved to the high point of trade. And if sentiment improves for one, it improves for everyone, because it's still a largely unorganized market where all these organized players are gaining shares. So let's see how this goes.
Absolutely. We'll take a quick break. We are back. Manisha will put the spotlight on commodities. Who knows, maybe gold is something she's eyeing. But I'm sure there's more. Stay tuned. That's coming up. Okay, welcome back. 35 lower on the Nifty is what we have. Manisha is standing by with what's top of mind for commodities. Manisha, morning.
Morning. Well, thank you for that, Prashant. You've been talking gold and the metals have continued to decline. But there's one thing that seems to be slightly inching up right now, and there is some opportunity buying, and that is the crude oil prices. Well, after declining 9 to 10% in the previous week, we've started crude oil prices slightly on a positive note. And this is one, there was some opportunity buying. It was slightly oversold on charts as well, with 10% of decline on a week-on-week basis. But the prices are firm on a potential hurricane in Gulf Coast. Remember, 60% of U.S. refining happens in Gulf Coast, and there is a hurricane building up, which might see a landing around Wednesday or Thursday. So whether there are shutdowns ahead of that, evacuations, is something that the street will keep an eye on. Well, as I said, the Brent prices have declined by nearly 9% in the previous week. We saw WTI prices decline by 10%, and this has been the biggest weekly decline that the crude oil prices have seen in last 11 months. And with that, the Brent is now trading at the lowest since December 2021 and WTI at June 2023 lows as well. Well, the markets also have seen, or not reacted rather, to the OPEC and allies postponing their increase of 180,000 barrels per day since the month of December. The markets clearly did not react to this much. We saw 1% of gain, and that also went by the intraday markets ending itself. Now, OPEC and allies also have said with this that they can be looking at a longer pause. They can also look at a reverse if needed, as in they can cut more output as well. And then apart from that, when you look at the OPEC and allies spare capacity, that is a huge 5 million barrels per day. I mean, with that kind of a capacity, markets do believe that there is bearishness that can continue. I also want to take you through what we've done in sense of price range in this year until now. We did see a high of 91. We are trading at 71 right now for the Brent prices, and from 87 to 67 for WTI. That's a $20 of a decline that we have seen until now from the highs in sense of crude oil prices there. In the Asian markets also, the Chinese demand is not so strong, and the refining margins are at the lowest since 2020 as well. There also is increased production from Libya that has come back. The money managers, the latest CFTC data shows that their also net long positions have been closing down. I'll quickly take you to the last slate, which tells you on what is the forecast now coming in for the crude oil prices. Bank of America, for one, says that for the second half, they've lowered the forecast from $90 to $75 a barrel as an average. You also have Goldman Sachs, which also has revised the forecast by $5 on the lower side for this year and the next as well to $80 a barrel there. Citi says that if you see demand destruction continuing like this and the supply coming in, there is a probability you could be looking at $60 a barrel for 2025 as well. Remember, we are trading at 71 already at this point in time, so that's $10 on the lower side. UBS is the only one that still continues to hold a bullish call on crude oil prices. They estimate that for this year now, 80 is where you could be averaging for the rest of the year.
All right, Manisha, thank you very much for that. Oil in focus. We shift the focus away from commodities, and we're going to take a quick break here now. So our special segment is the economy. My colleague Lata will be in conversation with Neeraj Seth of BlackRock, and they put the focus on global macro data. U.S. payrolls came in on Friday, slightly below expectations. We have Japan's second quarter GDP growth revised down slightly, and China's inflation rate coming in below estimates as well. All of that and more, and implications for markets with Neeraj on the other side.
down day for markets overnight. US indexes and Asian markets today are flashing red because growth data has been that way. The US August non-farm payrolls data on Friday, today morning's GDP data from Japan and inflation data from China are all mostly pointing to weak growth. Jobs in the US in August rose far less than expected, and even the July and June numbers have been rather substantially revised lower. Only the hourly wages ticked up higher than expected in the US in August. So how will all these impact actions from the US Fed and other central banks? Should equities rejoice over rate cuts or worry about global slowdown? What asset classes should one bet on? I have with me a person eminently placed to answer all these questions. Neeraj Seth, BlackRock's Chief Investment Officer and Head of Asia Pacific Fundamental Fixed Income. Neeraj, good morning. Thank you very much indeed for sparing time for us today. Well, first, the August payrolls and the revisions to June and July. How are you looking at the composite data? Is it pointing to a weaker US than you thought?
So it does actually point towards a gradual slowdown that we are experiencing in the US economy. So certainly weaker than expected, but it was still a mixed report. So I think the market's focus and zoomed in on the missing at 142K, the 86,000 of downward revisions for the last 2 months. And in fact, the weakness you saw in manufacturing and retail, losing 35,000 jobs. But as you touched on briefly, there were positives. The unemployment stayed at 4.2, or in fact came down from last month. You had 80,000 job growth in construction, leisure, and hospitality, which is still doing well. And you had the average hourly earning at 0.4 month on month, which translates to 3.8% year on year, which is a reasonably healthy level of hourly earnings, which translates to consumption in a consumption-driven economy. So yes, it's clear slowdown, but it's not falling off the cliff. But there's certainly an immediate knee-jerk reaction of focusing on the weak points and, in a way, redrawing the path forward with regards to the U.S. economy, the rate cuts very, very quickly.
Okay, so how should financial markets prepare in terms of the Fed? Are you still sticking to 1 + 1 + 1 in the current year? And therefore, what's the takeaway for the yield and currency markets?
So, two parts. One, obviously, on the Fed and fundamentals where we go, and then what's the impact on the financial markets. On the Fed rate cut path, I still think in a base case scenario, we potentially get 325 basis points of cut this year, starting in September. There is a possibility of 50 if the CPI data in the middle of this week surprises to the downside, which is not the base case scenario I would have today. So in terms of the market impact, I still like fixed income. I think it's a great time to be in fixed income. In fact, to be in the belly of curve in the US or taking longer duration in selectively emerging markets or in Europe. And equities, now combination of the September seasonality, upcoming political elections in the US, I'm a little more cautious with regards to potential increase in the volatility in the coming months. And specifically, September is never a great time from a seasonality standpoint. So I think the markets need to embrace for some volatility in coming weeks to next couple of months.
Okay. But what would be the range for the 10-year for you from now to end of year? Or even 12 months?
So I think in some ways there's a slight asymmetry at the 10-year point, more to do with the fiscal financing and less to do with the Fed rate path. So you can see a mid-threes on a 10-year, but you can obviously see backup going back to a 4% level. So I think we're sitting in the middle of the range right now, but the overall yield and carry that you can build in your portfolios gives you the cushion to actually counter some of that. But I do think you will see, but if I put it in very simple terms, the bull steepening of the curve, which is the front end keeps coming lower, even though it looks overdone for now, with maybe some steepening of the curve between 2 10-year part.
For the next 12 months, do you see migration of smart money from equities to bonds, especially in the US?
I don't think that's necessarily the trade I would focus on. I would look at more of the money moving from the sidelines, the money market funds, savings, the short end of the treasury to more into risk assets and fixed income. US equities, I think, still are well placed unless you see a big risk of recession going higher or the soft lending scenario turns towards a hard lending scenario. So I think the equities are placed okay in terms of where they are. obviously with higher volatility. But you do have close to $9 trillion in money market funds globally, with a significant majority in the US. You have a very heavy ownership in the T-bills right now, given what they're yielding. So I think there's a significant amount of capital sitting there, which even a part of it gets reallocated. I think that will come into your risk assets, specifically in credit, for locking in the yields where we are in this scenario.
Okay, your base case is the US economy is still, decent for people to bet on equities. Let me come to Asia. Japanese growth is lower than expected. China, I mean, inflation is just not budging, 0.5%. Do you see a fairly severe fall in, core inflation everywhere because of commodity prices falling? Our commodity expert was telling us that copper, several iron ore are all trading at multi-month lows. So is there a disinflation on in Asia?
So not in Asia, but you do have the disinflationary pressures in China, right? The data at 0.6%, which includes, in fact, the volatile food and energy. If you take that out, it was 0.3% for CPI this month, or this data that came out today. PPI was still minus 1.8%, which was, again, deeper in negative than expected. If I take a step back and look at what's happening in the economy in China, there's a structural shift towards more state-owned enterprising taking market share. The consumer sentiment, and that's a critical, remains weak due to a lack of job growth, lack of wage inflation, and the wealth effect coming from the negatives from the real estate sector. So all in all, the Chinese economy is still in a muddled through scenario with a weakening bias, and hence you're seeing that playing out through the commodities, specifically the hard commodities ex-gold, as well as to some extent oil, which I think will continue unless you see a rebound in the activity in Chinese market.
I'm building all this to your expectations on India. I mean, if there is this Chinese disinflationary overhang, as well as the US Fed more likely to cut than not, what's the expectation? Do you think India will also change stance and then cut before the year is out?
I do think in a base case scenario, I would expect RBI to move in December. Now, key is obviously we have the inflation CPI print expected this week, which I would expect to be in the mid-threes given the base effect and the food prices a bit better behaved. The monsoon has been okay, so we'll see how that plays out in rest of the year. But with the Fed cutting and the inflation maybe undershooting a little bit compared to the RBI expectations for this quarter and next, I do think there's room and potential for RBI to start moving in December. The key is the commodities, the oil price, both from an inflation as well as a macroeconomic perspective in terms of trade, it's actually a positive for India right now in terms of the backdrop.
That was, I mean, you're giving me the cue to the question that was in my mind. If you look at the global indexes, the active ones are still not really in India. They are quite deeply in developed markets. Do you think this jump will come as both the global macros look India positive because we are net commodity importers, as well the local situation is likely to become easy liquidity?
I do think the gradual shift is already happening. As you saw, the MSCI IMI index increasing India's weight now to the largest as a single country above China. In the standard one also, India is reasonably high, just behind China. You're seeing close to now $15 billion of inflows in the bond market, out of which north of 12 is just on the back of index inclusion, where we have only gone from 0 to 3%. We have another 70% as into 10% yet to go. So we're seeing this integration of Indian capital markets, and I would say a little more tilt towards debt at this point. Yeah. But as the markets remain buoyant, and if you do in fact get corrections, I do think the equity will see more flows in India, which we haven't seen as much this year.
Exactly. I mean, I have no complaints about bonds. There has been a decent inflow of fixed income money, but equity funds are still not looking at India as much as we would have thought. Many of them are underweight the active funds. So, I mean, if you were to advise them, would you advise step in? And what is your worry about valuations? In spite of the valuations, will you pick any sectors?
I think I would still stick with some of the growth sectors in India, more in the large cap. The valuations obviously look rich, But at the same time, this is when you start looking at the active management and look under the hood in terms of both the sectors and the companies which are less inflated in the valuation terms. And if I have to do it, I'll still be actually gradually still continue to build exposure in India, given if I take a 5 to 10 year view, it's still one of the best macro stories in the world, and it's hard to completely ignore it.
Okay. If you could be more specific in terms of which sectors you will pick right now. I mean, if you will talk stocks, nothing like it, but...
No, I unfortunately can't. Maybe
You
we
can't.
take that offline. I still like actually the IT services, the financials, some of the domestic stories in terms of consumer. The discretionary side actually is becoming more interesting in India as you get through a certain GDP per capita. So I think if you look at asset management industry, all those have secular growth trends. And I think that certainly is something which I'll be positive on. And lastly, I think the decarbonization effort, as you have seen the renewable power sector, I think they have a long runway for growth in India when you look at the government plans and the implementation from here.
Okay. Well, let me try and squeeze a last one. If you have to advise some rich person with money, what will be the top 3 asset classes you will advise?
For India or for global?
Both.
So I think where we are, I still would actually be, you always want to have obviously an asset allocation framework where you have exposure to the growth sectors in equities. I do think we still want to keep that. One area which I think is actually still under owned is the emerging markets, local currency, and maybe more selective. So the local currency, government bonds, and high quality credit. I think that's a very, very interesting sector, specifically given the shift in the Fed path from a rate perspective, opening the room for emerging market central banks to cut. And the third is private markets, and within that specifically private credit and infrastructure.
Okay. Now that calls for a separate discussion altogether, private credit and infrastructure. Thank you very much, Neeraj, for sparing time with us and whetting our appetite as to how to look at asset allocation and the interesting sectors that you point out in India. Well, on that optimistic note, wrap up on Bazaar. Chartbusters coming.
Market recovers from opening lows to trade flat despite a weak handover coming in from Wall Street following the August jobs report. Banking stocks trade with slight gains. The mid-caps are relative underperformers with cuts of nearly 0.2%.
Godfrey Phillips shares slip over 5.5% after shareholders approved the reappointment of Beena Modi as the company's managing director.
Ola Electric skids more than 3%, down 4% now as the post-IPO one-month lock-in period ends today. Nearly 18.2 crore shares are eligible for trade now.
Deep Industries has hit a 52-week high, surging over 17% after it has won an order worth over 1,400 crore rupees from ONGC. The order value is almost half of the company's market cap.
The new kid on the block, we have Gala Precision Engineering seeing a strong debut at a near 36% premium was the listing. The stock now trading at a 43% premium to its issue price of 529 rupees per share. Hello and welcome. You're watching us here on Chartbusters. I'm Mangla Malu. With me, Hormaz Fatakia. We saw the markets open with deep cuts. At one point, the Nifty was down by almost 100 points as well. But from there, we've seen a recovery, and the recovery has been led by Nifty Bank, which was an earlier underperformer, currently sitting mildly in the green. So one green block is what you can see on top of our heads, as against the three red ones, and the Midcap Index being a lot more in the red.
The Midcap Index is in the red. Firstly, welcome back to you, Mangalam. It's not a pretty looking screen if you look at the sector-specific indices. Although the Nifty has recovered from the lows of the day, the PSU banks continue to sell off from where